We're joined for more by Mike Wall, senior crude oil analyst at Genscape. Mike, always great to see you. So is it fair to say that Alberta oil has been under pressure lately?
Oh, absolutely. And what you're seeing is really the return of full production from maintenance periods in late 2019. And it's not that they're producing more than the curtailment allows. It's that they're now every producer is trying to max out their production subject to their curtailment allotments. And there's really a lack of any maintenance or reduction in supply over the past 2 to 3 months.
So in theory, I suppose the industry is leaving a lot of money on the table with that big discount north of $23.
Right. Well, certainly the upstream industry. There's certain integrateds and certain refiners that are most likely happy to see the differential widen out. But yes, in the view of a lot of the E&Ps and the heavy producers, yes, that differential widening is not the best news in the world.
Talk to us about I should know, we're just looking at a 5-year chart for the discount. It's not hugely out of line with the discount we've seen over the past 5 years. It is high, I know.
Right, and as we've been saying for the past year or so, when it was trading at -13, -12, that was too tight for rail, and that's when you start to see those inventories build. So this sort of differential in the mid-20s, the -22, -23, -24 range will incentivize rail. But the issue is now we need it to ramp quickly over the next 2 months or so in order to kind of bridge the gap until that spring turnaround season when we see a reduction in supply historically.
Rail transport. Now, I know Jason Kenney, the Premier of Alberta, has talked about potentially rail transport going to new highs, or certainly new highs in recent times, of 550,000 barrels a day. Do you think that's in the cards?
I think there's certainly the capability to do that if the differential supports it, especially with the added extra capacity we've seen over the past year and a half. So I think 550 is possible. Now that's going to have to be, again, incentivized by the differential itself. And where it currently sits right now, I think you're starting to see not just E&Ps and producers moving barrels, but now with the differential as wide as it is, you'll start to see some of the traders and the shippers that don't necessarily have their own equity barrels now start to move barrels down into the Gulf Coast because it makes sense for them economically.
Sorry, what's an equity barrel? It's a barrel you don't own?
An equity barrel is a barrel you do own.
Oh,
so if someone like Imperial produces a barrel from one of their large projects and then they sell that barrel, that is one of their equity barrels. Now, if you don't have your own production asset, then you're effectively buying barrels from a producer as a shipper.
Sorry, I meant to say, yeah, the people, the traders and stuff don't actually own the oil. Give us I think we've asked you this before, and I know it's really hard probably to put a precise number on it, but how much does it cost to move a barrel of oil south by pipeline and typically to move a barrel of oil south by rail?
Right. Well, now we're seeing by pipeline into, say, the Gulf Coast and down Keystone, we're seeing pipeline rates of the $10 to $12 range. So that means in order to be economic, you need the differential to be in that -10 to -$12 range. For rail now, if you go by what a lot of folks in the industry are saying, yes, the most economic movements by rail can be achieved by some of producers and some of the owners of rail terminals at the -15, -16 range, but the broader industry is probably closer into the -18 to -20 range, where that's where you start to really see barrels start to move out. So now that we're in that -23 range, I think you're starting to see that the incentive to move more barrels, and I think we'll see that coming in the next month or so.
It's quite a chunk of change, isn't it? If you were paying $20 a barrel by rail and the price for Western Canadian Select only about $35 right now.
Right. Well, I mean, you have to add in the transportation cost. So really, when I say it's economic at -20, that means if it's at -23, they're still making $3 a barrel, which is much better than losing money by moving by rail in the last year, or basically not being in an economic barrel when the differential was too tight.
So what's next? I mean, it's got to be frustrating for Alberta to see any kind of a discount. I mean, I know it's the nature of the beast. You can't change geography, given the big demand for heavy in the United States with the Venezuelan crude offline, for example.
Oh, absolutely. And heavy, Canada would be the preferred heavy oil supplier for the U.S. if they could get the barrels down if there was a free way or a more open way to get the barrels down rather than having keep running into this constrained issue. So we're still seeing a high demand for heavy in the Gulf Coast. And as I've mentioned before, Venezuelan's fallen off. Mexican is in a bit of a decline, although they have flattened a bit. And then in terms of Middle Eastern heavy barrels, whether it's Iraqi Basra or what have you, any type of barrel, really the easiest and the most desired barrel is most likely the Canadian barrel in the U.S. market. However, it's just hard to get it down into that due to the constraints.
And will enough pipelines be coming on, the Enbridge project, et cetera, to help relieve that, to get more of that darn oil south in the next year, say?
Right. So the Line 3 expansion is still up in the air. They've pushed the goalpost back a few times, but right now, as of late last year, Line 3, this 370,000 barrel a day expansion down into the U.S. is scheduled to come on either late this year or possibly early 2021. Now, there were some optimizations that were scheduled to go into effect this year. However, with the Keystone rupture, some of those planned optimizations, we believe, have been pushed back into at least into further into 2020. So that's why you're seeing less barrels being freed up than many in the industry were expecting. Now, we expect to see some of that extra capacity come on throughout this year. However, right now in January, we're not seeing a lot of evidence of that capacity being added.
So I suppose with this pretty hefty discount, Alberta won't be inclined to start scaling or to accelerate scaling back the curtailments.
Right, so that's a decision they're going to have to make because the flat price or the actual value of the barrel, like you said, is around $35, $36. Now, remember, in the dire situation of late 2018, we saw flat price or the value of that barrel get as low as $12.
Wow.
So it's relative. So yes, that -24, -25. I'm certain the Alberta government isn't necessarily as happy with that as -17, -16. But that being said, it's still not. We're still not in the dire situation that we're in late 2018 when you started to see producers shut in and you saw flat price bottom out at the $11 to $15 range.
Mike, it's always great talking to you. Thanks very much, man.
All right. Thanks a lot, Andrew.
Mike Wald, Senior Crude Oil Analyst at Genscape.